In this video, we're going to explore whether the stock market is going to crash again. I will give you the secrets you can use to avoid losing money during the stock market crash. Some of the greatest investors of our time are sounding the alarm of an imminent stock market crash, with many of them using similar metrics that we're going to discuss today. Crashes usually occur because of an overinflated market, also known as a bubble. According to Jeremy Grantham, one of the most astute British investors, this is the first time we have three asset classes bubbling at the same time: real estate, cryptocurrency, and the stock market are at all-time high. If we reach a state of pessimism in the market that leads to panic selling, Grantham believes that this will be the largest market crash in history. Michael Burry, the investor that is widely recognized for his prediction of the 2008 housing market crash, calls this the greatest speculative bubble of all time. A bubble starts to build when greed kicks in, and loads of people start to overpay for a stock in the hope of gaining incredible returns. If for any reason this hope starts to fade, you get a scenario where many investors start to panic and sell their shares. When you have panic sellers and not enough buyers, you get a drop in price. This is because in the study of economics, price is determined by demand and supply. Therefore, when you sell your shares with no demand to scoop up your piece of the pie, that could effectively cause the price to drop. Nobody can 100% predict when the market will crash, but there are a few metrics that we can look at today to understand when the stock market is overvalued and due for a correction. These metrics are what legendary investors like Warren Buffett used in 2008 to protect their investments when the housing market crashed. The first one is the Shiller PE ratio, which was named after an economist called Robert Shiller. This is currently at an all-time high since records began. PE ratio is a measure of how many years of profit it takes to recoup an investment. Shiller's PE ratio have been accurate in predicting a bear market since it was introduced, mainly because it adds inflation to the calculation. Inflation is simply a rise in the price of goods and services. Shiller's PE ratio currently sits at 39.35. The market average is 16.9, suggesting that the current market is strongly overvalued. A second metric that we can use to assess whether the market is overvalued is margin debt, also referred to as leverage. This is currently at an all-time high, which means more people are borrowing money to buy stocks than ever before. Charlie Munger once said there are only three ways that a smart person can go broke: liquor, ladies, and leverage. Trading on margin is dangerous because you cannot control what the market does. If the price of a stock suddenly crashes, lenders will ask you to cover your positions by adding more money or forcing you to sell. This is exactly what happened in the case of Archegos Capital. Even the most intelligent investors cannot time the market, hence why it is better not to invest using borrowed funds. A third metric that we can use to measure overvaluation is the Buffett indicator. It looks at the ratio of the entire United States stock market valuation and compares it to the gross domestic product known as GDP. GDP is the total value of goods and services produced in a country over a year. It is simply a measure of a country's national income. The Buffett indicator is currently sitting at 63% above the historical average, suggesting that the market is strongly overvalued. Between 2020 and 2021, we saw an exponential growth that has never been seen before in the history of the stock market. The S&P 500 almost doubled in under 2 years, something that typically takes about 7 years. With many people staying home due to the COVID-19 pandemic, we saw a major influx of individual investors in the stock market, many of them who still believe that they are pushing back against the big hedge funds. We saw this in the short squeeze of GameStop and AMC. I don't want to bust your bubble, but I have to ask you a question. Do you think the party will continue, or do you think the bubble is about to bust and everybody's gearing up to go home? Feel free to share your comments below. I mentioned how Warren Buffett has managed to escape the 2008 financial crisis. That's because he classes himself as one of the investors that use a strategy called value investing. Value investing is a strategy that long-term investors use to scale through a market crash. Value investors typically don't worry themselves about the idea of a stock market crash and only think of it as a market correction. In the short term, prices can rise to the moon. However, in the long run, the stock market will correct itself. When the stock market is not seen as the most attractive place to invest, people might decide to just save their money in the bank or put it in less risky assets. As an example, when inflation rises, central banks will typically raise interest rates. This makes borrowing more expensive and savings more attractive. People save their money and companies can expect to generate less revenue. If investors expect revenues to go down, then they are not willing to pay high prices for a stock, and this usually leads to a market correction. We have seen this in the late 2021 sell-off as investors feared that the Fed would taper faster and raise interest rates earlier than expected. Peter Lynch once said, "There's always something to worry about in the stock market. The key question you should ask yourself is whether you have the stomach for these downturns." Even in a stock market correction, companies with strong balance sheets that are buying back shares can see their share price fall. A correction in the market is the perfect opportunity to pick up stocks at discounted prices. And no, I'm not talking about buying the 2% dip. I'm referring to the kind where you see stocks plummeting by 30% or more and you still buy. We have seen this with companies like PayPal that have fallen by 41% from their all-time high. Other stocks that have suffered a major correction in 2021 include Robinhood, which is down 74% from its all-time high. Zoom is down by 60%. Twitter has fallen by 48%. Please smash that like button. Without a doubt, the stock market will crash again. Better yet, it will correct itself. So, what should you do today to protect yourself and avoid losing money in a stock market crash? Number 1. Master the craft of picking stocks with great fundamentals or just simply stick to ETFs. The only way to secure your investment and ride out volatility is to avoid making decisions based on your emotions. Number 2. Having a sustainable strategy is key to investment. One of my strategies is to incorporate a margin of safety. I typically use about 20 to 30% margin of safety. What you decide to use will depend on your risk appetite. Your analysis should give you a number of when you plan to buy or sell a stock. Without this, you will find yourself dancing with the panic sellers. Where you currently are in life will determine if you really need to worry about a market crash. If you're young and planning to be invested in the market for the next 10-15 years or even 30 years, then there's probably nothing to worry about. If you're planning to be invested for less than 10 years, you need to be thinking about rebalancing your portfolio or even an exit strategy. This is simply because you don't want to find yourself in a position where you're forced to sell your stock at a loss. Now, I understand that some of the things that we've discussed here today might be a little bit scary. If you decide not to invest because you think the market will crash, you need to understand the opportunity cost. According to previous studies, the cost of not investing in the stock market is about 3.3 million for each millennial in their lifetime. Let that number sink in and think about what that could mean for your future. If you decide to continue investing or you're about to start investing, try to stay invested for the long term. Naturally, the market will fluctuate and correct itself. So only invest what you're willing to lose without that loss having any effect on your daily life for the foreseeable future. If you're new here, consider subscribing so that you can receive notification for my next video on Tesla. Until next time, my friends, stay curious and be happy.